Okay, we are recording. Hello, everyone. In this lecture today, we're going to go over chapter 4, which goes a little bit more in depth into the income statement and the statement of stockholders' equity. So we've seen both of these already, but now we're going to discuss a few circumstances that call for some different approaches to the income statement and a little bit more comprehensive approach to the statement of stockholders' equity. So we're going to look at those together. And then, of course, just like always, we're going to get practice with this in class. So I am going to share my screen with you. We are going to get this pulled up. Okay, so chapter 4, again, we're getting into, let me minimize this so I don't have to stare at myself here. Chapter 4, we're getting more in depth into the income statement, and then we're also going to look at the statement of stockholders' equity and information that relates to that. And some of this, of course, was not discussed in principles of accounting. So we will have some new terms here and show some new categories in the way that they would presented on the income statement or on the statement of stockholders' equity. So the usefulness of the income statement, I mean, obviously net income, we say, is the bottom line figure. Like if, when we talk about financial information, if someone says, what's the bottom line, right? They're relating to, or they're talking about net income on the income statement. So it is useful, in the fact that it evaluates our past performance. It evaluates how we did in the previous accounting period. It's a way, if it has that predictive value that we talked about in chapter 2, it's a way of predicting what we expect to happen in future accounting periods. And then it helps to also assess the risk or the uncertainty in achieving future cash flows, right? So we're able to kind of see on, from some of these items, if we determine that the company, for example, has a healthy net income, or if there's the possibility, for example, if there's been a net loss of achieving future cash flows. Some of the limitations, however, and we've talked about this before, is that, income, when we're measuring net income, we're looking at, strictly past, so we're not necessarily looking toward the future, right? Companies can leave out items that do not necessarily or cannot necessarily be measured reliably. Income may be affected depending on the accounting methods employed. So again, they're showing us the example here of whether we use straight line method or accelerated depreciation is going to affect our income. Whether we use FIFO, first in, first out, or LIFO, last in, first out, that's going to affect our income, right? So the accounting methods employed will affect income. And then also income has some level of judgment in that some of our estimations are not concrete, but what we think is going to happen. I can give you a couple examples of that, like when we think about depreciation, usually we estimate a salvage value or what we expect to be able to sell that asset for when we're done using it. And it, depending on how accurate our salvage value estimation is, that could potentially, for example, if we dispose of that asset and we're able to sell it for more than what we thought, then that can be recognized as a gain, right? That can affect our income, increase our income. If we sell it or salvage it for less than what we thought we would, then that we would recognize a loss from that. So that would impact our income. The other kind of big one is that, we judge on receivables. We judge, what percentage or what portion of those are uncollectible. And again, this is an estimation. It's a judgment. And so it might not be 100% accurate. We might collect more than what we thought we could. We might collect less than what we thought we could. So those are both instances where it would have an overall effect on net income. So some of the limitations there. All right, so elements of the income statement. I think for the most part, we have seen these and we have gotten practice with some of these things before. So again, revenues are inflows or other enhancements of assets or settlements of its liabilities that constitute the entity's ongoing major or central operations. And then expenses, the outflows or other using up of assets or incurrences of liabilities that constitute the entity's ongoing major or central operations. And it's given us some examples here. Again, I think all of these we have seen before, and we'll continue to get more practice with them as we go through the book. But revenue accounts, you know, we can have sales revenue, we can have fees earned, which is a revenue account, interest revenue, dividend revenue, rent revenue, for example. And then on the expense side, we could also have rent expense, salary, wage expense, tax expense, depreciation expense, interest expense, and then of course we know that cost of goods sold is an expense as well. All right, so some additional elements of the income statement that that we haven't necessarily talked about in depth before in Principles of Accounting are gains and losses. And we touched on gains and losses in chapter 2 when we looked at the conceptual framework, because remember in the conceptual framework we had those 10 elements on that second level, 10 elements of the financial statement, and gains and losses are 2 of those elements. So remember, gains are increases in equity from peripheral or incidental transactions. So peripheral or incidental meaning not in the normal course of business, not in our normal, you know, operating functions of business, but outside of our normal outside of our normal operations, right? Same thing with losses. Losses are decreases in equity from peripheral or incidental transactions. So again, not losses from our core operating activities, but from peripheral or incidental transactions, right? And so it gives us some examples here. Gains and losses can result from, for example, the sale of investment or plant assets, the settlement of liabilities, or the write-off of assets. And again, as we continue through our textbook, we are going to get practice with calculating several different types of gains and losses on these things. So we will get a lot of practice with this as we go through our book. All right, so some of the other components, and I touched on this a little bit when we just looked at chapter 3, or when we looked at our income statements in chapter 3. We refer to these type of income statements as multi-step income statements, because what we're going to do is, you know, it's not just simply revenues minus expenses equals net income like it would be in a single step income statement. A multi-step income statement, we take, you know, revenue minus cost of goods sold equals gross profit minus operating expenses equals net income from operations. And then from there, we want to add, you know, any gains or other revenues, subtract any losses or other expenses, and also income taxes. And then there's a few other things that we need to consider in there. So just like it shows here on this multi-step income statement, it separates operating transactions from non-operating transactions. And we're going to see this once we click to the next slide and we look at an example of that. And then highlight certain components of income that analysts use for assessing financial performance. Because, you know, again, the operations, that's our main, you know, income from operations, that's our main business activity. And so, you know, we look at that if we were putting, you know, different forms of revenue, like, you know, what revenue is more important type thing. revenue from operations and income from operations, you know, has a higher value or is viewed as more important to investors, right? Because that's our main operating activities. But then we also want to look at some of these kind of peripheral or incidental transactions with gains and losses and discontinued operations and things like that. All right, so, you know, again, here's some of the potential intermediate components that could be found on a multi-step income statement. Not all of these are going to be on every income statement because not all of them are applicable to a company, but what will always be on there? Number one, there's always going to be kind of the income from operations section. Generally speaking, there'd be the non-operating section, which this is where we would find like gains and losses. And then we would have income tax, and then we would show earnings per share. So 1, 2, 3, and 6 are kind of applicable to every income statement, right? Every company's, every corporation's income statement. Number 4, discontinued operations. Number 5, non-controlling interest. These are what are not necessarily applicable to every company. So these would only be included on an as-needed basis, or you know, if it's applicable to the company, you know, they'd be included on the income statement as well. So here's an example of this multi-step income statement. Again, it looks very much different than the single step income statement that we've prepared a bunch before. So single step income statement, you know, again, revenues minus expenses equals net income, kind of, you know, very simplistic form of the income statement. But now we're looking at this multi-step income statement. Obviously, you know, we've got a few things going on here. So we're taking, and I believe we did touch on this in, I want to say chapter 12 in Principles of Accounting, although by that point in chapter 12, you know, we were at the end of the semester, and I don't think we spent a whole bunch of time on it. I know we prepared a couple of them together, but nonetheless, here on this multi-step income statement, we're taking our total revenue, that's our sales revenue, and then we've got to subtract any sales discounts, sales returns, and allowances. That gets us to net sales revenue, or our net sales. We take our net sales minus cost of goods sold to arrive at gross profit, and that's what we see here, right? So net sales minus cost of goods sold equals gross profit. And then from there, we subtract out our operating expenses. In this case, they have them divided up into selling expenses and administrative expenses. And so if we take our gross profit minus selling and administrative expenses, that gives us income from operations. And now we have some other revenues and gains. So dividend revenue, rent revenue. And then we have some other expenses and losses, interest on bonds and notes, interest expense. So then that gives us, we subtract, so we were at 186,073. We added in our other revenues and gains of 171,410. That brought us up to 357,483. And then we subtract other expenses and losses of 126,060. That takes us down to 231,423. And then we base our income tax, so that's our income before income tax. We base our income tax off of this number, so then we subtract our income tax, and that gives us net income for the year. And that's what we use to calculate earnings per share. And basically, we're going to see the formula for earnings per share as we continue through the PowerPoint slide. But basically, to calculate earnings per share, we're taking net income minus preferred dividends divided by the weighted average shares outstanding. That's how we get that earnings per share figure. Oh, and here, just what I pointed out to you now, it's got these red arrows here. I forgot about those. All right. So here's a condensed income statement. Again, you know, pay attention to these selling expenses. So remember, selling expenses 453,028, admin expenses 350,771. If we go back, you know, that's our selling expenses here, 453,028, admin expenses 350,771. We've just condensed them. So we've only just put the aggregate number as opposed to breaking them down into the individual selling expenses, or we've just put the, you know, the aggregate admin expenses as opposed to breaking down each administrative expense. So that's what we're kind of looking at on the condensed income statement. We're just aggregating the numbers and showing the totals here as opposed to each individual expense category, for example. All right, this was our beautiful single step income statement. And single step income statement, obviously we can see here by looking at it, it's a lot less complicated. We like it a lot. The thing with the single step income statement, just like it shows here, is that with the single step income statement, it treats revenue and expenses as all of the same. Like, all revenues are equally important, all expenses are equally important, so that not, you know, no revenue has priority over another, no expense has priority over another, which is fine. But generally speaking, we like to see that income from operations, right? So we like that multi-step format because we get to see, you know, basically our income from operations, our income from the most important part of our business, or the main part of our business. All right, so various income items. So we touched on these a few slides back, and these are some things that, again, you're not going to see in every income statement. You're not going to see at every company, because every company doesn't necessarily have these things. But when applicable, then it'll show us where these things belong. So, you know, again, unusual gains and losses, you know, we'll usually have a section for gains and losses. So we would have, you know, net income or income from operations, and then under income from operations, we would list the unusual gains or losses, right? And that would give us then net income before income tax, right? So that's number one, usually we're going to find on most income statements. Also number 4, remember, earnings per share. That's another figure that we're going to find on these multi-step income statements. But the two that are only, like, you know, when there is an applicable situation is discontinued operations and non-controlling interest, because not every company is going to have discontinued operations, and not every company is going to have non-controlling interest. So those are the two that are kind of more on an as-needed basis, right? So unusual and infrequent gains and losses. Again, unusual being a high degree of abnormality, which means not happening all the time. Only incidentally related, the ordinary to the typical activities of the company. So, like, we use the example of an infrequent gain would be if we sold a piece of equipment, that, you know, and we had a gain on it, that would be an infrequent gain. Or if we had a loss on it, that would be an infrequent loss. It's not included in our normal business activities, but peripheral or only incidentally related to our normal business activities, right? And then infrequency of occurrence, again, type of transaction that is not reasonably expected to recur in the foreseeable future. Again, using the example of we sell equipment. I mean, you know, large property, plant, equipment assets have very low turnover. So even though we sold one in 2019, doesn't mean that's going to happen again in 2020. It might not happen again for a couple years or whatever, right? So those are our unusual and infrequent gains and losses. And so your book talks about a survey that was given to companies, and this is a survey by 500 large companies, and the most, you know, the most, how do I say it? So companies reported the most gains and losses in either restructuring charges or write-downs, which is impairment, or gains or losses on asset sales, disposal of assets. So that's kind of where we get the most gains and losses, right? But some common types of unusual or infrequent gains and losses. So again, losses on write-downs or impairments of receivables, inventory, property, plant, and equipment, goodwill, or other intangible assets, restructuring charges, gains and losses from sale or abandonment, disposal of property, plant, equipment, effects of a strike, gains and losses on the extinguishment or redemption of debt obligations, gains and losses related to casualties such as fires, floods, earthquakes, gains or losses on sale of equipment or sale of investment securities. So again, of these, what do we got? 1, 2, 3, 4, 5, 6, 7. Of the 7, the 2 most common are restructuring charges or impairment or gain or loss on disposal of assets. All right, another type of income item, again, this is more, like I said, on an as-needed basis, is when there are discontinued operations. There's a special way that those have to be listed on the income statement. And so discontinued operations are when a company eliminates the results of operations of a component of the business. So, you know, I don't know, maybe we could use the example of Ulta Beauty. So I don't know. I'm not a real good spokesperson, or you know, maybe this won't be a great example, although my sister worked there. I've never actually been in an Ulta Beauty store, but my baby sister worked there, and so I know a little bit about it anyway. And I know that at least the Ulta Beauty by my house, they not only sell makeup and different things like that, but they also have salon services, right? So if they decided to discontinue their salon operations and focus just on the retail side of things, then that would be, you know, they would eliminate the salon services and they would eliminate those results of operations from that component of the business, right? Or a discontinued operation could also be, or is also, when the elimination of that component represents a strategic shift or has a major effect on the company's operations and financial results. So, you know, two things, I guess, you know, both of these are required. The company eliminates the operation or the component of the business, and that elimination represents a large shift or what will have a large impact on the operations and financial results. And just like we show here, the amounts for discontinued operation, the amounts are reported net of tax. And that's important to remember, because I know you have a multiple choice question where we need to know, for example, I forget exactly how it's worded, but we need to remember that discontinued operations are reported net of tax or after taxes are taken out, right? Net of tax means after taxes are taken out, yeah? All right, so here's our example of this, and I'm just gonna get, hot dog, all of our numbers pulled up. So KC Products, Inc., a highly diversified company, decides to discontinue its electronics division. During the current year, the electronics division lost $300,000 net of tax. KC Products sold the division at the end of the year at a loss of $500,000 net of tax. Show how the discontinued operations would be reported on the income statement for KC Products. So again, we'd have income from continuing operations, $20 million. And then we would list the discontinued operations. So there was a loss from operations net of tax, a loss on disposal net of tax. So the total loss on discontinued operations, $800,000, which drops our $20 million in income down to 19.2, or 19,200,000 after we subtract that loss from discontinued operations, right? All right, and then here it shows too on this one, where I mean, and it showed us kind of the loss of operations, the loss of disposal. But here it just shows it, you know, with the next slide shows it the entire income statement, right? So again, we've got, you know, sales minus cost of goods sold equals gross profit. Hot dog, what did I do? Gross profit minus selling and administrative expenses equals income from operations. Income from operations minus other revenues and gains, other expenses and you know, other hot dog, other expenses and losses, gets us to that, you know, income before income tax. And then we list our income tax, and then underneath our income from continuing operations. And if we didn't, so if we didn't have, if we did not have discontinued operations, just like it shows here, this would be net income, right? That would say net income. If we did not have discontinued operations, then that red arrow that you see there would just be net income. But we have discontinued operations. So then instead we call it income from continuing operations, 276,000, minus discontinued operations. And again, it's showing us income from operations of pizza division less applicable income tax of 24,800, loss on disposal of pizza division less applicable income tax of 41,000. So overall, we've got income here, and then we've got loss here. So the difference between those two, $36,000 loss. So that reduces net income to 240,000. All right, if we have a gain, so we saw an example where discontinued operations resulted in a loss. Now this example is showing us that discontinued operations can result in a gain. And so this one says, Schindler Company has income before income tax of 250,000. It has a gain of 100,000 from discontinued operations. Assuming a 30% income tax rate, Schindler presents the following information on the income statement. So again, if we took 250,000 times 30%, then on that income before income tax, 250,000, we'd have income tax of 75,000, which would bring our income from continuing operations down to 175,000. And then if we had a gain of 100,000 less the 30% tax rate, then we've got an overall gain of 70,000, which then brings net income to 245. All right, here's discontinued operations at a loss, which we've already seen on a couple examples of, but say we had a loss of 100,000 less applicable income tax reduction of 30, that would be an overall loss of 70,000. All right. All right, non-controlling interest. So non-controlling interest, just like it shows here, when a company owns substantial interest, generally greater than 50% in another company, generally accepted accounting principles require that the financial statements of both companies be consolidated together into one set of financials. So non-controlling interest is the portion of equity interest in a subsidiary not attributable to the parent company. So here's our example of that. It says, assume that Coca-Cola acquires 70% of the outstanding stock of Coke Company. Because Coca-Cola owns more than 50% of Coke, it considers Coke's financial results with its own. GAAP requires that net income be allocated to the controlling and non-controlling interests. So that's what we see here. We see the consolidated net income, gosh darn it, of 7,000. This touch mouse drive me crazy. Touchpad, whatever you want to call it. All right, so consolidated net income 7,124 less the net income attributable to non-controlling interest. So then the overall effect is our net income attributable to stockholders of the Coca-Cola Company. So it just separates out any income attributable to that non-controlling interest. So, you know, essentially, Coca-Cola is separating out any of the net income that it earned off a Coke company, basically is what it's doing there. And then earnings per share, we've seen a couple examples of earnings per share. Again, this formula is not complicated by any means. Net income minus preferred dividends divided by weighted average of common shares outstanding. So not a difficult calculation. It is a significant business indicator insofar as it measures the dollars earned by each share of common stock. And again, according to generally accepted accounting principles, and if you're a publicly traded corporation, this is something that is required to be disclosed on the financial statement. All right, so here's our example of that, and let me just click through this so we can get, okay, so this says, Lancer Inc. reports net income of $350,000. It declares and pays preferred dividends of $50,000 for the year. The weighted average number of common shares outstanding during the year is 100,000 shares. So if we plug all of our numbers in, we compute earnings per share as follows. So we've got net income minus preferred dividends divided by weighted average shares outstanding. So then we would report a $3 earnings per share. Now, when we have situations like discontinued operations, for example, then we might take this a step further and we might report earnings per share from and separate of the discontinued operations as well. And I think we see that here on the next slide. So, you know, again, if we have discontinued operations, then we might break this down to, okay, earnings per share of common stock, earnings per share of income just from continuing operations, earnings per share from incomes from discontinued division, earnings per share for loss on discontinued operations, or, you know, earnings per share based on our bottom line net income figure. So a couple different ways that we can calculate this, but generally speaking, this $2.40 is what we would want to see, earnings per share based on that bottom line net income figure. All right, so a couple other reporting issues that we have to talk about and that may have or may not have effect on our statement of retained earnings or our statement of equity. So accounting changes and errors. So if there is a change in accounting principle, like for example, we're moving from you know, straight line method depreciation to double declining balance depreciation, right? That might require a retrospective adjustment, or we might have to go back and adjust the last couple years, right? If we have, for example, a change in the accounting principle as it relates to inventory, like it's given us the example here, if we change from FIFO to average cost, or if we change from the percentage of completion method to the completed contract method, those could require a retrospective adjustment, which means we need to go back and adjust the past couple years. And that has the potential then to have a cumulative effect adjustment to retained earnings. And we'll see an example of that. And so when we do that retrospective adjustment, then we're able to preserve comparability across years. Because one thing they say is, like, for example, you know, if we choose the FIFO method, we want to use FIFO every year. That way we're able to compare financial statements. Or if we choose, you know, to value, or what was the other example that I gave? If we choose to do depreciation, you know, using the straight line method, and then we decide to go to a different method, then we can't necessarily compare apples to apples, right? So by going back and doing these retrospective adjustments in this case, it gives us the abilities to still compare apples to apples year over year, or have that comparability. And so here's an example. It says Gaubert Inc. decided in March 2017 to change from FIFO to weighted average inventory pricing. Gaubert's income before taxes using the new weighted average method in 2017 is $30,000. So then what it's doing here, so in 2017, we prepare our financials using that weighted average inventory method, and that's all fine and good. But now we need to go back and we need to make a retrospective adjustment to 16 and to 15. So in 16 and 15, we were using the FIFO method. And so in 15, we reported inventory of 40,000. Well, under weighted average, we would have reported it as 35. And so there would have been a difference of 5,000. In 2016, using the FIFO method, we reported inventory as 30,000. If we use the weighted average method, we would have reported inventory as 27,000, which again, that $3,000 difference is what we need to make an adjustment for, right? And so we would make this adjustment in retained earnings, essentially. All right, change in accounting estimates. So again, accounting estimate, we estimate, for example, the salvage value of an asset. We estimate the uncollectible, or what we expect bad debt expense to be. And it's given us these examples down here. So useful lives of the asset, we estimate, we expect this asset to last us 5 years, for example. We estimate salvage value. We estimate the allowance for uncollectible accounts. We estimate inventory obsolescence. So, some of these estimations, when we need to make adjustments to these estimations, we do not have to go back to prior years. We don't have to adjust retained earnings retrospectively. We just make the adjustments in the current period and future period if the change affects both. And that's what it's showing here. Accounted for in the period of the change, or the period of and the future periods if the change affects both. Not handled retrospectively. We don't have to go back, and it's not considered an error. We just simply need to make the adjustment. If we expected the asset to have a useful life of 5 years, and now it's only going to have a useful life of 4 years, we need to record more depreciation, for example. Or if we estimated salvage value to be 5,000, we didn't get that much for it, then we need to record more depreciation. Or if we estimated bad debt expense, maybe we estimated the allowance to be $1,000, and we actually did not collect $2,000, then we need to adjust that bad debt expense. Whatever the case may be, right? All right, correction of errors. So accounting errors result from mathematical mistakes in application of accounting principles, and oversight or misuse of facts. Corrections are treated as prior period adjustments to the beginning balance of retained earnings. And, when we get into, and I know most of you are going to end up taking auditing as you get toward the end, if you haven't already taken it, I guess, as you get toward the end of your coursework. We look at mistakes as departures from GAAP. So whether it's a mathematical mistake or it's a mistake in the application of the accounting principle, we look at whether it's material or not. Is it a material mistake? Is it a material departure from GAAP? Is it a material misuse of facts, right? So, either way, whether it's material or not, we want the data to be correct. We want the financial statements to reflect the most accurate information. But sometimes these things, again, for for purposes of, you know, is there a gross misstatement? It's whether or not it's material. So here's an example. It says, in 2018, Hillsborough Company determined that it incorrectly overstated its accounts receivable. So it overstated accounts receivable and sales revenue by 100,000. So if we overstated revenue, that would mean that income was also overstated, right? So in 2018, Hillsborough makes the following entry to correct this error. And we see that here, a debit to retained earnings. Because remember, when we earn net income and we transfer that net income to retained earnings, we credit retained earnings. So when we're reducing retained earnings, then we're debiting retained earnings, crediting accounts receivable to get both of those back to where they should be. All right, so retained earnings statement, and you know, again, I mentioned this in the previous chapter and maybe in the previous chapter before that, but the retained earnings statement is very similar to the statement of owner's equity. So if we think about increases and decreases, so increases, equity or retained earnings in this case increases when we earn net income. It can also increase from a change in accounting principle. You know, LIFO, for example, LIFO usually results in higher cost of goods sold, so lower net income. So if we changed from LIFO to FIFO, then we'd probably have an increase in retained earnings, because that would have increased our net income the previous year. And then prior period adjustments, decreases arise from net losses from dividends, potentially changes in accounting principle, potential prior period adjustments. And so here's our example of that statement of retained earnings. Again, very similar to the statement of owner's equity. This one, we take beginning balance plus net income minus dividends gives us that ending balance, right? So on this example, and on the next slide, it's going to show us the corrected or the adjustment into retained earnings. But this one says, before issuing the report for the year ended December 31, 2017, you discover a $50,000 error net of tax that caused 2016 inventory to be overstated. Overstated inventory caused cost of goods sold to be lower and thus net income to be higher in 2016. Would this discovery have any impact on the reporting of the statement of retained earnings for 2017? Well, yes, because if we overstated inventory caused cost of goods sold to be lower. When cost of goods sold is lower, that results in a higher net income and would have resulted then in a higher retained earnings, right? So what we need to do then is we need to adjust the retained earnings 50,000 essentially. So that's what we see here. So we take into account that prior period adjustment. So instead of being at, you know, I think on the previous slide, we're at 1,110,000. Now we're at 1,060,000, right? After we made that adjustment. Okay, comprehensive income and other comprehensive income. So like it shows here, all changes in equity during the period except those resulting from investment by owners and distribution to owners. So comprehensive income includes all revenues and gains, all expenses and losses, except for those resulting from investment by owners and distribution to owners, right? So all gains and losses that bypass net income but affect stockholders' equity. And so we see here comprehensive income includes not only net income, but then any unrealized gains and losses on available for sale securities, translation gains and losses on foreign currency, and other special situations like that, right? One statement or two statement approach to comprehensive income. The one statement approach, we list net income, and then the other comprehensive income, which would then make net income plus other comprehensive income gives us our comprehensive income, right? So that's one way to do it. Or the two statement approach, simply in one statement we have net income, and then the other we add that to other comprehensive income to arrive at comprehensive income. Again, we're going to get more practice with this once we are in class working on some of these chapter 4 exercises. Not too bad, I think. All right, and then finally we look at the statement of stockholders' equity. Again, statement of stockholders' equity gets a little bit more in depth, if you will, or a little bit more comprehensive, if you will. When we think back to the statement of owner's equity, the statement of owner's equity pretty much just included, you know, beginning balance plus net income minus owner withdrawals equals ending balance, right? I mean, that's all it really was. But now, when we think about the stockholders' equity, we think about some of the potential categories or some of the potential accounts included under stockholders' equity. Could be common stock, preferred stock, treasury stock, additional paid in capital, excess of par, retained earnings, dividend, you know, these can all be included under stockholders' equity. So it gets a little bit more complicated, a little bit more comprehensive. And so just like it shows here, reports the changes in each stockholder equity account. And again, I just rattled off a few of them that could potentially be there. And then also on the stockholders equity, we disclose any shares that were issued during that accounting period, and any dividends that were distributed during that accounting period. And then we also would reconcile the carrying amount of each component of stockholders' equity from the beginning to the ending period. So just like we saw in the statement of owner's equity, just like we saw in the statement of retained earnings, we always have to reconcile it by taking the beginning balance plus or minus any additions or subtractions to arrive at the end of the period dollar figure, right? That's shown on our balance sheet. So here's an example of that. So we've got the total for each, and you know, it's showing us the total column here. When we looked up Apple earlier, and I think this was when we were going over, I can't remember if this was chapter 1 or chapter 2 now, but they showed the total column on this side. You know, it doesn't really matter. I mean, either way, these categories should add up to the total basically, right? So 300,000 plus 60,000 plus 50,000 adds up to the beginning balance of 410,000 there. Then we're adding net income that gets added to retained earnings. We don't have any, looks like dividends in this case, but we did have, let's see here. What is this? Unrealized holding gain net of tax of 30,000. So, you know, in this case, our main categories of stockholders' equity are retained earnings, accumulated other comprehensive income, and common stock. But like I said, there could also be preferred stock. There could also be treasury stock. There could also be additional paid in capital, excess of par. There could also be dividends, right? So, so it could even get a little bit more complicated than this. Balance sheet presentation. Again, each one of those sections from stockholders' equity would be found here on the balance sheet. And so we see that's where we get our total stockholders' equity from. And then finally, some of the differences between generally accepted accounting principles and then those international financial reporting standards. So we'll start with the similarities first. They're similar. GAAP and IFRS are similar in how we report non-controlling interest. They're similar in how we report unusual and infrequent income items. And there are the same presentation guidelines for discontinued operations. Both recognize items in equity as part of comprehensive income, and both allow the one statement or two statement approach to preparing the statement of comprehensive income. So some of the similarities there. Some of the differences, GAAP allows for a single step or multi-step income statement format. IFRS requires that companies to classify expenses either by nature or function. IFRS identifies certain minimum items that should be presented on the income statement. GAAP has no minimum, but SEC rules and requirements are a bit more rigorous. Remember that GAAP had 10 financial statement elements, whereas IFRS only had 5 financial statement elements. So SEC rules and GAAP requirements are a bit more rigorous. IFRS does not define key measures like income from operations. And then under IFRS, the reevaluation of property, plant, and equipment and intangible assets is permitted, but gains reported as other comprehensive income. So, you know, generally speaking with GAAP, for property, plant, and equipment, we would use the historical cost concept. As we saw in the previous chapter, IFRS allows for the fair value measurement principle. So there are some differences there. So that is the end of chapter 4. Again, I'm excited to, let me stop sharing that. Hi guys, hi everybody, guys and gals, I guess I should say. So anyway, I'm excited to do some of these exercises and get practice with some of these things in class together. But nonetheless, this should at least give you, after reading the chapter, a little bit more breakdown, a little bit more understanding of the concepts covered. And again, I look forward to getting practice with you guys in class together. Bye-bye. See you later.